All right, first off is why everyone should have a home-based business. It's a crazy world. I'll be honest, for 20 years I was in your shoes. Actually, more than that. So all through school, spent 20 years in corporate accounting, and not until about 2013, so almost 7 years ago, when like I said, I was no longer invited to go back to work, and I found myself unemployed. And then the fall of that year, I met a gentleman up in Brampton, and he did a thing about how to pay less tax. I'm like, wow, that's pretty good. I'd like to know how to pay less tax. And he showed me how the tax advantages of having a home-based business, and it blew my mind. That year, I increased my tax refund by about $7,000. And then since then, every year, I've made sure that I've maximized my tax refund. And then, like I said, 3 years ago, I started doing it for my clients. Last year, the majority of my clients all received a tax refund. Only a couple of clients actually had owed money, but they owed money because they were running successful businesses. And at a certain point, you can only be so much of a magician, or you can only do so much magic. At a certain point, there's only so many tax deductions. Eventually, you have to pay a little bit of tax. Except there's my name at the bottom, Dwayne Richards, the letters, the CPA, the CMA, and the LLQP. It's the life insurance license. So I am licensed for life insurance as well. All right, let's see. Really quick, it's not a recruiting tool, but I actually if you know anyone who's in direct sales or running a home-based business or who's in network marketing, this presentation is a perfect presentation to show people why using taxes, not about being a seven-figure earner and all the other things, having fancy cars. No, show how use tax and the tax reasons and the tax savings I'm going to show you tonight to show why your friends, your neighbors, your brother, your sister, your neighbors should also have a home-based business, because right now they pay a lot of taxes and their everyday expenses are not tax deductible if they just have a day job. This works for Canada as well as in the US. The presentation tonight, it's a Canadian audience, but all of the stuff, I just swap out the T4, put in W3. So if you have family or friends that are based in the US, the content of tonight's presentation is exactly the same for if you're in Canada or in the US. Somebody's typing something into the chat, but I can't get my chat window open. All right. Ask your questions in the chat, and I'm going to breeze through this, and eventually I'll get the chat window back. Let me just see if I can move some stuff around here. Find out where my chat window went. Chat. There it is. Okay, I have someone's question. My account. Yeah, so definitely there's a my account, and I'm going to share a couple things at the end of tonight about my account. A couple quick tricks, as well as to show you a quick tool on how to find out if you have any uncashed checks issued to you by Revenue Canada that you may not have claimed yet. All right, let me close some of these windows. Move that guy's out of my way. So many windows. I got two screens and still so many. Okay, so here's the quick example. So this is for a lot of the people that in the room have your day job. The average household income in Canada is about $75,000. That's a household income. That's two people, or it's one person, and the other person may have a stay-at-home mom or a stay-at-home dad. So you have one person earning $75,000, or the two people combined $75,000. If you're earning $75,000, not sure what, I'm not going to survey the room as to say what, I'm not going to ask you how much you earn, but if you're earning $75,000, you're paying just over $10,000 a year in income tax. If you're earning $100,000, you're moving even higher. You're into the $15,000 to $20,000. When you're in the 125 bracket, in the 125,000 bracket, you're paying over $30,000 of income tax. You're paying pretty much the same amount of income tax as some people earn. You still got a provincial tax on top of that, right? So provincial tax is based on that. So you're paying another 5%, another $5,000 in income tax. CPP is not a tax. CPP is your Canada pension plan. So the CPP is not a tax. So we can't really do much about that. It's going to be there. It's going to be there when you're 65. Don't worry. There's lots of money in there. We're good. I'm not sure about our kids. I know Greg and I are pretty good because there's going to be money in the CPP for us. But my sons are 14 and 16. I think there might be money for them, but that's their problem, not mine. I'm going to show them how to make sure that they're financially not safe, but financially independent. And the CPP money will just be bonus money. As well, in a future episode or a future week, I'll share some strategies about why you want to actually defer CPP to age 70. I know most of the people in the room aren't 70 years old, so it's not really top of mind. But what I want to show you is as you approach 60, 65, and 70, some tax planning strategies why you want to wait to age 70 to take CPP, because if you wait to age 70 to take CPP, you're going to get an extra 140%. How many people want an extra 140% in their retirement? I know I sure do. And generally, depending on your earnings and how long you live, it can work out to an extra $100,000 of retirement income. An extra $100,000 of retirement income by deferring CPP to the age of 70. Hopefully that makes you say, All right. And of course, EI. We all know what EI is. It's an employment insurance, but it's employment tax. It's a tax. It's a payroll tax. We call it insurance. If you get laid off or lose your job, or sometimes with COVID, you got some extra money and you have to pay into it to be eligible. What I'm highlighting here is that potential tax refund. I'm referring to this as that you've paid money on your T4. You paid income tax at source. In this case, I'm looking at this $10,000 as a potential tax refund. And now you're saying, well, how's that work? I want to know how I could get some of this money back. And I'm like, well, that's why you're here tonight. You came to the right spot. All right, let me just click this button a couple more times. So welcome to the world of tax deductions. Tax deductions are significantly different than tax credits. I know a bunch of us are all supposed to be accountants, maybe, but maybe we're not all accountants. I actually had to take corporate tax back when I was at Waterloo doing my management accounting degree. And I'm going to be an accountant, but I'm not going to practice tax. I hated tax, to be honest. I didn't understand it at all. 20 some years later, here I am talking about taxes. Who would have known? All right, so here's the deal. The whole idea of the home-based business, I'll use myself as an example. Here's what I didn't do well because I didn't know. I spent 22 years as a hockey referee. Minor hockey, it's generally a cash business. And when we were doing it, we're like, no, we would never do it if they gave us a T4 or made us pay tax on this, because we're only making $20 a game. Maybe in a season, you made a couple $1,000s, right? And if I had to pay tax on that couple $1,000 in my tax bracket, all of a sudden I'm only taking home, instead of $1,000, now I'm taking home $700. I got to pay $300 in tax. And I'm like, oh, but what do? We had that mindset, right? About the mindset. It's a cash business. So it's like doing stuff for your neighbors. Like, here, I'll cut your neighbor's lawn and just pay me cash, right? So I received cash as a referee. It's not illegal. Most of the organizations were nonprofit, and that was part. We got paid cash. But what did I miss out on? Anyone want to tell me what I missed out on? I missed out on tax-deductible business expenses. Because what did I have to do as a referee? I had to drive my car to the arena. I needed a car. Or if I didn't have a car, I had to take the bus. I had a car, so I took the car. I had my cell phone. I was generally paying, who knows, but now we're paying about $100 a month for a cell phone bill. And I had to have internet, right? Because at home, I had to have internet. And it's a bit of a stretch, but I had to have a home office, right? Because I had to have somewhere where I'm hanging out and waiting for the phone to ring to go referee a hockey game. So now, if I would have claimed those 22 years on my taxes, I could have easily have claimed my mortgage, definitely my car, 50% of my cell phone, 50% of my internet, because those expenses were incurred for the purpose of gaining and producing income. They were incurred with a reasonable expectation of a future business. I said business, it's a little bit gray as a referee. I wasn't necessarily a business, but I was an independent contractor. So let's use a different example. So if people are in the room, if you're an independent contractor, you could be a consultant. Gets a little bit gray, so you just have to be careful. So if you're a contract employee means that you're on contract working for a single employer. And if that employer is responsible for 90% of your income or more, you're actually an employee. You're not really an independent contractor. So you need to have a couple different, you have to have a couple different customers. That's why it's better to use a home-based business. So if I have a home-based business like my son does, my 16-year-old son, he has a snow shoveling and a lawn mowing business. This year we bought him a snowblower. He's got the lawnmower, actually uses, so he's got the lawnmower, he's got the snowblower, and now he can go out and he can mow people's lawns, he can shovel snow. But guess what? Now his cell phone is a tax deduction. It's a great way to have your kids make them pay for their own stuff by getting them a business. Greg's laughing. All right. So, okay. So it just has to be, so what my point is that you don't even have to be making a lot of money. I have clients that made zero income in their first year to 2 years because they had to get stuff going. You had to go find some clients because you're working a day job. You're working 9 to 5, maybe you're working 50, 60 hours a week already. You don't have time to go to networking events and not like bang on doors and hit the pavement, but you have an idea. As you're developing your idea, you're letting CRA fund your idea process. So first off, it has to be an expense incurred for the purpose. There has to be a purpose. There has to be an end goal of earning income. Next off, there has to be a reasonable expectation of a future business. Can't be a dream. There has to be a reasonable business. It has to be reasonable under the circumstances. So you can't go out and say, well, I'm going to be an Uber driver and I'm going to go buy a Maserati. That's not reasonable. Go buy a used Honda Civic. That's reasonable. All right. Plus, there's a cap on your auto. In case you didn't know, CRA caps the CCA, the capital cost allowance on an automobile at $30,000. So it's not actually tax advantage. It's not advantageous to be driving a Maserati. It may help your Uber rating, but it's definitely not going to be cash flow positive as a business. All right. Let's keep going here because I said we're going to wrap part of this up by 8 o'clock. If people want to go watch Netflix or something, maybe. Or maybe they want to hang out and learn about how to save money on their taxes as tax season's fast approaching. So here's a quick example. So as we talked about it is be reasonable. You want to be audit proof. So don't claim 100% of your phone. This is my phone. It's a very lazy asset until I had a job or until I had a business. Now I have a business. I'm going to now expense 50% of this phone. My monthly bill is $100 times 12. That's $1,200 divided by 2. That's a $600 tax deduction. Tax deduction. I'm going to explain deduction to you in a second. Internet, $80 a month, 50%, 12 months, $480. Plus the $600. Now we're at $1,080 as a tax deduction. My car, average car in the GTA, on average, this is a couple years ago, probably a bit more now, average annual cost to operate a car is $10,000. If I can make $3,000, if I can make 20% business use kilometers. Now I know lots of people had no cost in kilometers because everyone's running online businesses because with COVID, we can't drive anywhere. Okay, so I don't make my car, but I still have that car cost, but my costs are actually less as well. So all of a sudden last year, maybe it didn't cost me $10,000, but I still want to make a portion of my car tax deductible. There's strategies, and that's why you want to book a call with me, because I have strategies to show you how to increase from 20%, from 10% to 20% to 50% to 70% business use kilometers for your car. A car is expensive sitting out in your driveway. It costs a lot of money just to have your car sit there. Might make it a tax deduction. Or maybe you don't have a car. And you'd like to have a car at some point. Well, let's show you how to make that car tax deductible. And driving Uber is highly unrecommended by myself. I have a couple clients who are Uber drivers, and it's not profitable at all. Actually, it costs them to drive Uber. All right, home office. So the key here is the home office. You can do square footage or percentage of rooms. The thing that you have to know about home office is early in your business, you can't make your tax write-off. You can't make your business loss bigger with a home office, because they're like, you're gonna have the home office whether you're making money or not. So I can't make, if I'm already losing money in my business early on, I can't make the loss bigger because of a home office. I can have a loss carry forward. I can still have that, so when my business grows, I'm going to write off a portion of my mortgage or a portion of my rent. Business travel. A couple of things I didn't have on the list that are fantastic is personal development training. And here's a quick thing. Tuition, right? A lot of people went to school. Probably a bunch of the people in the room went to school. Tuition is a tax credit. So you pay like $10,000 in tuition and you get a tax credit. So you get a 15%. So you get a $1,500 reduction on a $10,000 bill. Oh, thanks. Thanks a lot. Better than nothing, but it's not 100%. Now, new for 2019 and carried into 2020, there's now a $250 training credit. So if you take a course on your own and you've spent $250 or more, it doesn't have to be from a college or university. It has to be a training related to your employment. You can have that credit. But I want you to do what my client did in Vancouver, where she did a whole week-long event with Tony Robbins, spent about $10,000. And because she had a home-based business that generated a mere $1,000 of income, we expensed her $10,000 training with Tony Robbins, triggered her a $9,000 tax loss, applied that $9,000 tax loss against her T4 income tax, which resulted in a 30% refund, which triggered a $3,000 refund. Pretty good. Revenue Canada paid a third of her income, third of her expense to go learn from Tony Robbins. Plus the traveling to that event and staying in a hotel was also tax deductible because she had a home-based business. All right, let me click through this. All right, so as an example, I want to share this because sometimes maybe it's not you, maybe it's your spouse, or maybe you know someone who's a stay-at-home mom or a stay-at-home parent. You're like, oh, that's a great idea, but if I start earning money, I'm going to have to pay tax. Just to let you know, if you're not earning, I'm pretty sure everyone in this room is making money. It doesn't really apply to you, but this is also good for kids. For my son, kids under the age of 18 pay no income tax. Also, on your first $12,000, that's the basic personal exemption. I just showed you $12,000 less the business expenses, so you could earn your first $16,000 of income and not pay a nickel in income tax. It's pretty good. All right, let's just keep going. Hire your kids. How about that? If you have a home-based business, it has to be reasonable. You can't be paying your 19-year-old, $500,000, or you can't be paying them $100,000, but you can pay them something. Figure out what your kids can do. I have a 16-year-old son. Instead of hiring him, he wouldn't got his own business, but I could hire my kids to do, if I want to do flyers, they could do your social media. They make some phone calls. One of my clients, I called him and his 15-year-old daughter answered the phone. His 15-year-old daughter is his receptionist. Pretty good. Pay your kids, and then the money you pay them is tax deductible, and then let them pay for their own stuff. Let them use that money to pay for their smartphone, pay for their sporting events, pay for college. Now you just found a way to make college tuition tax deductible because you paid your children a salary. They use that salary to pay for their tuition, but the salary you paid them was a tax deduction. You want to figure out how to have your kids' tuition be tax deductible? 100%? That's how. Pay your kids. As long as they're under 18, no CPP, no EI, and no income tax has to be deducted up until the age of 18. All right, so in summary, here we go. I think we're doing close to on time. We're a little bit after 8, but really quick. The timing is perfect right now, right? So many people joined and started home-based businesses last year because all of a sudden they had 3 extra hours. They weren't riding the GO train an hour and a half each way. They weren't commuting in from Hamilton into the GTA to go to their job. They still had their job, but all of a sudden they had these extra hours every day that they weren't spent commuting. Everything went online. My business, 100% of my business is online. I have tax clients in Vancouver, Alberta. I'm licensed to do business in New Brunswick. 100% online. I use DocuSign, everything online. Entitled to deductions. The whole conversation here is based on the Income Tax Act. Audit proof. Just have to have the receipts and be reasonable. And a reasonable expectation that you're going to make some money. Hire your family. You can hire me. Accountants to do your taxes are tax deductible. If you have investment income or self-employment income, the cost to have someone do your income taxes is tax deductible. The cost to get tax advice or investment advice, if you have investment income, rental income, or personal or self-employment income, tax deductible. The key here is about tracking your deductions. Like Greg gave me the reminder, the key here is to make sure that your tax files are complete. So if Revenue Canada comes knocking and wants some receipts, say today or tomorrow, which day do you want them? Okay, that's pretty much it.